All right, good evening, guys. Ken at Tortoise Capital, nightly strategy podcast for September 17th, 2021, Friday night. So we'll be looking at the weekend reports and getting ready for tomorrow's trade framing. Tomorrow's the last Foundations course Q&A, I think. Now we'll go all the way through September. So we got a couple more there, Louisa, to work our way through. And then a new course starts in October. I'm doing a guest lecture on Monday for the Tharp Institute. Van and Kala are driving back to North Carolina from Las Vegas, coming through Kansas City tomorrow, so they're going to stop in and have lunch. And it'll be good to catch up with good friends. It's good to see them. Okay, so these are a couple bighorn sheep out in Bob's part of the country, up in Colorado. Notice they're pulling a good 360-degree security, so can't sneak up on them. Working in pairs, that's good. That's good trading practice right there. Well, sorry, I had a hard work today. All right, so let's start with the market health check, and let's see what we got going on here. So yesterday we talked about this setup here, where we had the peak RL10, an all-time high. We then had a P1, then an RLXD, and it sold off to the Bollinger Band mean, and then spent about 3 or 4 days kind of in this wide range sideways chop that was great for intraday directional trading, but netted out to nothing and was sitting right on the Bollinger Band mean. And I said, well, I would be ready to go long if it took out the top. On a swing basis, I'd be ready to go short here if it took out the low, because now it's leaving the river. And I said, meanwhile, I would be ready as an intraday trader for this much tighter bracket of about a 50-cent risk, ready to get a directional bias out of that, like on an intraday trading for like futures or leverage ETFs, or intraday trading on markets that are correlated to the S&P. And then, so what we got today on a Friday was a gap down opening and then a strong directional sell-off to close weekly at the lowest low of the last 10 days, halfway from Z1, edge of the river, to Z2, the edge of the floodplain. So that was as weak a move as you can get, and well, strong to the downside. Let me say it that way. Now we'll notice that the 3-period whole moving average is really strongly pointing down. We kind of broke through this cluster of support, which was at the previous belly of the dragon and the RL10, which makes this a collapsing dragon move. It was that's the thick red line is the dragon. The thin red line was the southern skin of the RL10. Then this line had been the previous 10-day low and a 2.5% sell-off from the top, right? So that's what 2.5% looks like. So now we're into that next leg of corrective price action. So this has all signs pointing to down. Let's see. The PSAR has continued to roll over and grinding downward. The RL30 extension is more steeply pointing down. The Bollinger Band mean, which had been directionally up, has now gotten directionally flat. that is significant. I want you to notice the thick green line here of the RL90 had been really strong all the way up, and now it got flat. So both of those indicators are showing something like intermediate term peak being developed, and it's the same kind of mentality that when you see the RL10 peaks here and then starts to slope down, it's that same kind of price action, only now in a more on a longer term. And in the same way, the RL30, which had peaked, which had rolled up, then got flat and is now sloping downward, all of that is indications of topping action, and that makes this move down to Z2 and Z3, and stopping briefly at the 30-day low. All of that is in play. Because remember, the size of the move this week was from peak to trough was that thick. Let's do that one in orange so that we can see it more easily. Yeah, so this orange arrow is the magnitude of the of the weekly move. So if we clone that, we would say, yeah, next week, if it's only as bad as this week, could look like that and get all the way through Z3, right? So that's not good unless you're on the short side. So this is a market that is offering a critical state once more. So I'm going to just say, look, this same idea is I'm ready to put my short-term trader's hat on and straddle the close on Friday, and I will be ready. Since I'm neutrally biased, I'll be ready to go long there or short if it is continuation. Either one of those is likely to be a strong move. All right. So that looks like a critical state trade to me. And probably talk about that on Monday with the Tharp Institute folks. Okay, so that's what the longer term trend is down, terminated in a critical state, great for short-term traders. Okay, let's take a look at the sectors. All right, so the S&P today was down 1.3%. That was the worst performing of the 6 broad indexes we follow. The Qs were marginally better at minus 1.18. Diamonds were only off 0.73. Treasuries were down 0.5 to close at 149. Emerging markets were marginally better at minus 0.43. And the best performing of the broad indexes we follow, the Russell, which was up a fraction at 0.13. So that was kind of the anomaly today, that there was some speculators ready to take intraday advantage of a counter-trend rally. That's not a position I'd have held over the weekend, but that was a tradable move today. So let's take a look at the downside and see what contributed to the weakness in the broad market. All right, so again, the market was down minus 1.3. The first group of sectors that failed larger was the large cap blended crypto, GDLC, then wood, and then S&P Tech at minus 1.5. Then we had the other lumber minus 2%, materials in Mexico 2 and 2.2, and then the worst performing sectors, Brazil minus 2 3/4, and then Ethereum off 4%. The underperforming targets. Now, yesterday we talked about the likelihood of a strong directional move in the metals. It could have gone either way, and so the vote was down today, and that was TX, the steel company, 8% loss. U.S. Steel off 8%. Cliff Natural Resources, a steel company, off 5 1/4. Then we had PayPal, Apple, John Deere, Microsoft, Devon Energy, all underperforming. So a lot of industrials in there. But then Microsoft and Apple being weak, not a good sign for longer term. All right. So that still makes me want to look at metals and mining and the materials sector next week. So I'll be looking for Ken H to give us some trade frames. Give yourself a try at that. Try your hand at it, I meant to say, and see what you come up with. All right, so things that were better than the S&P. The first cluster of sectors was, reading from the bottom up, wheat and precious metals, commercial real estate, oil exploration, blended commodities, agriculture, Bitcoin trust, oil, and energy. So that's all between -1% and -0.75%. The next cluster, marijuana, lithium, and staples, down 0.5%. FANGs and finance, 0.5%. Blockchain and consumer discretionary, down 0.3 and 0.2. Moonshots actually in the green, a solid 1%. And then a really nice move out of this cluster. S&P Biotech, 1.5%. Clean Energy, 2%. ARC Innovation, 2.5%. ARC Genomics, 3%. The VIX, 6.5%. And then individual targets that outperformed. Virgin Galactic, 8%. Robinhood, Coinbase, Tesla, Squarespace. So there's some disruptors that were working, but otherwise very narrow outperformance compared to the S&P. So this was a narrow group of winners. So just tactical plays there altogether. I do like the fact that Tesla was able to close the week above 750. That's still going to be a grim line in the sand to defend. There's 750. Everything north of 750 is good. Okay, so there was only one chart posted today, so let's take a quick look at that if we can. Yeah, so this was Alcoa. There was just not much room in Alcoa. This was correctly notices the so gap down, sell off, and now here's a collapsing dragon or a pocket entry in here, failure at the VWAP. That's a perfect short, and then that would have reinforced the win on the trade he actually took, was waiting for a full, like a Z3 excursion to the downside, and it was a great 1-2-3 exit, but that gets probably 3 times better if you take the entry at the VWAP failure. A pretty good re-entry, maybe a little bit slow. Could have been here. Still, that's not bad. That's a good scratch. You had no way of knowing that was the next move. This is a slow re-entry. I think you want to be here, and then you would have made this a winning trade. Good job staying out of the chop at lunchtime. This was a reasonable effort on the downside that didn't follow through, so I like the quick scratch. I'd have been very tempted to get it right here. But the Z3 pinch and then a failure, reasonable exit. There just wasn't much room in this thing at all today. So the net for the day was fractional losses, but with I think what I would say is proper play in here, we'd made back. This is a hybrid frog opportunity early in the morning. That's a much more advanced trade pattern, so I don't recommend that until you've got your 1,000 trades in on the more deliberate SSCs and COTA 2s. But that's kind of where that initially getting paid is possible after a big collapse down when we were expecting big downward moves in Alcoa and all the metals. But continuing to March, doing a good job of self-assessment here, so in great shape. All right, let's go right to the weekend reports then. Excuse me. So we're still in bullish normal. Now only the long-term 270 is overbought. We have neutral on the midterms here. And then severe weakness on the short-term NDXs. The risk Z has been a reliable warner of us when that started rolling over, warning us about these volatility spikes to the downside. It is now approaching -1 on the Z score. The next stop is over here. We're probably going to see that next week. When the Z score gets beyond -1, then that's an indication of significant weakness. The real estate and treasury plays still holding up pretty well in the blended monthly rebalancing. ETF2 reduces to 40%, so only 4 of the 10 big indexes are above their 4-month moving average. Oops, I hit my screen power button there. Sorry. We'll take a look at the market health checks for the longer terms. So this long monthly gain that came out of the COVID sell-off, that's feeling like it's at risk now of breaking below the previous month's low. And you'll notice that it really hasn't done that since the start of COVID. All of these other ones, at worst, were flat. This one is getting dangerously close at 440 to reversing that very long-term intermediate upward trend. I'm concerned about that. And 440 is like right here on the 9-day. This is like a 2-week market health check. And again, notice we're starting to see that significant rollover. Here was the last one. It resolved to the upside, so this is not by any means but the troublesome thing is that this ended on the low note, whereas this one had already started its little bit of recovery. Here was a moment of concern that resolved to the upside again. So, you wonder, how much more resilience is there? So we've had 1 nice recovery, 2 nice recoveries, 3 nice recoveries. Each one is a little more shallow and stretched. So this one, there's a concern I have on that 2-week. This does feel like an intermediate top. The weekly has now had 2 weekly lows in a row. You have to go all the way back to here to see that, and all the way back towards COVID. So troublesome. And the week, the going into the weekend on a sour note has not been helpful. And again, 440 is right there. That feels like a pretty important price level with the PSAR flip getting ready to happen. On the 3-day, you can just see that's the worst looking sell-off since this one, and that was a move that went from 424 to 405. So that was a $20 sell-off. That would take this from 454 to 434. So that's all in play. That's still a play down to the Bollinger Band mean. So there's another $12 to $15 of weakness just baked into cake under normal conditions. So that's troublesome. Like this move over a 2-week period was from 439 to 420. So that's almost $19. So again, this move down to the Bollinger Band mean is well within norms. It wouldn't even be surprising, which is to me why you got to have the I'm not going to let that go below 440. And we've already seen the market health check. The 3 strongest symbols had reasonable 1-week performances, much better than the uber weeks in the globals. And the Russell had the anomaly of gains this week. Energy is now trying to buck that longer-term sell-off trend, but again, that is purely a tactical trade, in my view. The U.S. and Biden are doing what we can to make energy go up by, reducing production, turning off ANWR, stopping fracking. They're trying to drive up energy prices, so that's what happens to gasoline when you turn off the pipelines. Price of gas goes up, imagine that. In the ETF 32, oil explorations had a pretty good run here, XOP. Clean energy had a good day today, so there may be a little bit more room left in that one. And I guess I have to say something about Japan. It's an equity market that's not the U.S. and not an emerging market and not Europe. So maybe it's Japan's time. Microsoft has been the bull elephant there in the Dow. And Apple has been going in fits and starts. They are not going to benefit from the news that the officials at the Fed were buying for their personal accounts. They were buying bonds that they were directing the Fed to buy with institutional money. Unbelievable. Unbelievable, unaccountable, irresponsible, undermining fiscal purity. Just staggering tone deafness on guys that ought to know better. How they can be allowed to do that is defies explanation. In the sector spiders, the leaders all did fairly well. There was nothing spectacular to write home about. Tech has been holding up fairly well, but we want to see some follow through. In the regional report, the U.S. large caps and the growth were the strongest areas in the world market model. The emerging markets were getting smashed mostly. Not much to choose from. Biotech and semiconductors are the green and the whites for us to look at. Otherwise, it's tech and growth. That's all tech and all growth right there in the U.S. The only safe havens. The greens and the ATR percentage, those are ones that are liquid and volatile enough intraday for good trading. There's, again, regional banks, biotech and oil exploration, gold miners, Brazil, energy. And the Russell's not bad. Shifting to the daily. We got quite a few channeling and overreaction signals baked into the cake. Not surprising given the weakness of the move today and the weakness of the whole week in the last 10 days. So we got some mechanical swing trades to frame in the broad indexes in the U.S., EFA, and in Europe. Lots of NDXs jumping out at me there in the Dow. Plenty of channeling and overreactions. Plenty of auto framers. And then 3 good 5-day downs to get after. Cisco at 2.5 to 1. Goldman Sachs 2.4 to 1. And Nike is a reasonable setup. Lots more breakdowns in the globals in the ETFs. So lots of lots of support levels were broken. Plenty of channelings and overreactions to choose from. Plenty of auto framers to choose from. So you can afford to be very judicious on that. Okay. Auto Framer giving us standard mechanical swing trading, 1 day at a time. There's all your mechanical trade frames, and there's so many to pick and choose from. You should be looking for your favorites and looking to exploit that familiarity. How do you not love Johnson & Johnson at 7-1 though? And I love Asia, less Japan and Brazil. Emerging markets in healthcare. That's nice. Only a couple squeezes because of the magnitude of today's negative move. The multi-time frame NDX, the predominance of red is just telling you how widespread the painful selling has been, with very few positive signs whatsoever on the horizon. So this is defensive time and maybe short-term bounces for our coyote opportunist. You see that weakness, and now the range is beginning to expand. The slope of the RL30 has now moved out of that yellow zone, and now alerting us to significant move downward is happening. That failure is crucial, and the percent stretch is showing that it's broken that support level previously, and now it's more than 2 standard deviations of weakness compared to the 200-day moving average. That's a real problem for that intermediate time frame, and we saw that on the market health check with the slope of the river flattening out and rolling over, the RL90 rolling over, the RL30 already pointing down. This is the great unwinding of the aging bull, and volatility is increasing here. Yep, here's 440. If that breaks, look out below. The RL10 is giving an alert already. The weakness in the RL90 slope and even the RL30 slope and the RL90 starting to roll over as well. When that thing started rolling over here, notice that there was a lot of pain and suffering inside that market. Many corrections all along the way. So that's what I'm concerned about in this next forward-looking period. All right, that's everything we got. We'll get this published and posted. Thanks for your kind attention. We shall see you tomorrow. And I'm going to give a preview of the Monday podcast in tomorrow's podcast by showing some of the lessons learned from COVID trading and the highlights of our foundations course for the people. So take good care, and we shall see you tomorrow.